Hi. In most of our webcasts, we talk about current problems that are creating issues for people in the real estate industry right now. That is not what this webcast is about. What I am talking about today is a phenomenon that is happening right now that if it does cause problems, those problems are unlikely to manifest for 2 or 3 years. The reason to watch this video is so that you're not part of creating the problem yourself for others and for yourself. So here's the concept. There is a conventional wisdom right now that is reasonable to have, this conventional wisdom, that as long as lenders are receiving payments on their loan, the lenders aren't looking for excuses to call the loan due. For example, the lenders aren't looking for violations of what are called due on transfer clause to create an opportunity to call the loan due. That's a feature of virtually all mortgages, virtually all deeds of trust, that is designed to allow a lender to protect itself from increasing interest rates. And the concept is that if title transfers, if a lender makes a loan from A to A, if a lender makes a loan to A, and then A later transfers title to B without paying off the mortgage, then the lender can call the loan due if the lender discovers the transfer from A to B. You're thinking, well, number one, how many people sell their property without having B pay off their mortgage? John, that's not going to happen. But it does happen. It happens because people take title, for example, in their own name. And then later, as they develop wealth and the like, for example, they might want to convey title to that property to a limited liability company. It happens at the closing table when people buy property. Because they get better interest rates, because the underwriting is easier, they take title in their name as individuals, and then shortly thereafter, they transfer title to their LLC for estate planning or asset protection planning reasons. Now, I will admit to you that in our current economic climate, it is extraordinarily unusual. In fact, I don't think I have seen it happen for about 25 years that an institutional lender has called a loan due simply because of a due on transfer violation. But we have to remember we are in unusual times. This video is being recorded in the pandemic in October of 2020. And let me show you a graph to give you an historical perspective on some things. So what this graph is showing you is mortgage interest rates that in my lifetime at least in 1981 peaked at about 18%. And then over the course of the next 35 years, the next 40 years, mortgage interest rates have trended down, 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 to the point in time where I'm recording this video right now in the midst of the pandemic, where in October of 2020, it's not unusual for people to get 30-year fixed interest rate mortgages. Yes, it's true, 30-year fixed interest rate mortgages at 3%. Now, because interest rates have been trending down, when lenders learn of these transfers, they haven't had much of a financial reason to call the loan due. And in my career, they learn about the transfers because all of a sudden the name on the insurance is different. They learn about the transfer. Because they're starting to get calls from a property manager that's different than their original borrower. In my career, I have only seen 2 situations where a lender is being paid on the loan, they're getting regular payments, they've called the loan due. But those periods have happened in blips like this point in time. In this time frame between September of 1993 here and March or so, the end of 1994, interest rates went from essentially a low-ish of about, this chart says 6.86%, up to, essentially 9%. That's an increase of interest rates of 30, 40%. And I have seen lenders call loans due in these sort of micro increases that we've had historically in interest rates. Now, who knows what the future holds from now? I certainly don't expect mortgage interest rates to get back up to this point in time. But is it possible that they could go from 3% now to 6%, say 5 years from now? Well, this chart suggests yes, because here's the 6% row, and 6% is still low by historical standards. If interest rates got back up to 6%, I think it is quite likely that whoever is holding that debt at that time would start proactively looking for violations of due on transfer clauses. They would start doing title searches and the like, looking for transfers to LLCs, looking for other kinds of transfers, assumption transactions, subject to transactions, and looking for excuses to call loans due that were originated in 2020. What can you do to manage this risk? And the main thing to do to manage this risk is don't find yourselves telling people don't worry about due on transfer clauses. Don't find yourself as a closing table saying to borrowers, don't worry, you can take title in your name and convey title to your LLC tomorrow or next week or next month and don't have to sweat about it. No, if interest rates do get back up to the 6% level out here, that transfer that occurred 3, 4, 5, 6 years ago is something that the lender can use in the future to call the loan due. So when somebody's talking to you about the risks of transferring title to their own LLC, you say to them, haven't seen many problems with that, maybe haven't seen any problems with that, but who knows what the future holds. Interest rates may go up. This will sound self-serving. It is a little bit self-serving. You should talk to a lawyer about how to manage those due on transfer risks. There are ways of managing the due on transfer risks. The complexity of it is beyond the scope of this webcast. It's beyond our attention span in these webcasts. But there are ways of managing those risks. You just want the people you interact with to know that there is a due on transfer risk in this scenario where interest rates go up. That's all I have to say. Remember, we live in a complex world. Be careful out there. Catch you on the next one.